Hello, 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 everybody. Excited to be here today on YouTube Live. So, we're trying out some new things and ways to communicate, and wanted to spend a little bit of time this week talking about the markets. And there's been lots of volatility, there's been lots of worldwide geopolitical upset. There's been just a number of things that create a lot of ups and downs in the markets, and just wanted to decipher a little bit of what's happening, talk about kind of the year in review a little bit, and then just talk about where we might go from here and some of the dynamics that are taking place. So, first and foremost, have to get our disclosures out of the way. So, here's our phone numbers if you ever need to reach us. All right. So, we weren't able to can't do live comments on YouTube because of compliance rules. But if you do have a question, I would like you to email that if you would to Will. I put his address here on the screen. So if you have any questions along the way, he's in the room here with me and he will get a hold of me and let me know what that is. So again, it's will at pfwplanning.com. All right. So I characterize this as a stormy season because one, it's gotten cold here in Iowa. Hopefully, we're seeing people all over the world and you have nice warm weather. But here in Iowa, it got really cold and kind of stormy and rainy. And it reminded me of a time when I went out to see Natalie in Rhode Island, my stepdaughter, and we were going to land at the Rhode Island airport in Providence. And as we were coming in, man, it was just storming like crazy. The wind was whipping. There was you couldn't even see because of the rain. And as we got close to the landing area, it was clear then that the pilot had pulled up. So tried to land, it didn't work, and so um, Lisa didn't even notice. I certainly did notice and was becoming very concerned. There was a guy in front of me literally trembling with just the volatility of the whole situation. Well, they brought us around, and the gal landed, excuse me, our pilot, and we all clapped and shouted and said thank you for getting us there safely. And so it can feel like that sometimes when you're an investor. The storm, if you watch the news, it's so predicated on bad news. I saw a CNBC headline today about Apple, who came out with a great report, who had a good stellar quarter and said something about a gloomy forecast. Well, Apple doesn't even do forecasts because they want to focus on how they've done, and that's what their earnings reports are about. And so it's just interesting to me how the bias enters into so much that's reported. And so if you've been listening to the markets commentaries this year or watching CNBC or reading the Wall Street Journal, wherever you get your news, there's just lots of bad news. And it seems like, has the market actually done that well? And it's been a crazy year because the parts of the market, the stock market anyway, that have done well have been highly isolated, more so than I've ever seen. And then with bonds, we've just seen the continued challenge with interest rates and stuff. So wanted to get into a little bit of that today. One thing that is a bright ray of sunshine actually in this current environment is our economy keeps growing, and we just had another good GDP, which is our global domestic product, is the U.S. economy growing print here in the third quarter, and it was also strong. So you can see the trend line on this is 2%, and you can see how it has averaged its way up, and it's continuing to do that right now. So I was on a call last week with Rich Bernstein and talking about no one's discussing how strong the economy remains. There's been talk all year about this inevitable recession, and it just has not come to fruition. So when anybody tells me consensus or they tell me inevitable, I have to shake my head a little bit because no one knows what's going to happen, and this year's proves that once again. And so, does this mean this will last forever? Heavens no. There'll certainly be corrections along the way. You can see the '08 dip on this graph. You can also see the COVID dip on this graph. And then the right-hand side shows the components of GDP, and almost 70% is consumption. And what that is what you and I spend, where we make our dollars out into the economy, whether you're spending it at Costco or online or wherever you do that. So as long as people are spending money, the economy will keep growing. And the reason they're doing this, I believe, is because anybody that wants a job right now can have one. So this chart shows that unemployment remains very low. And if people are out there looking for work, generally speaking, they can find something. Now, wage growth back to March of 22 has come down. So wages aren't going up as much, but people that are working are making about the same wage or slightly higher. And so we expect this is probably going to moderate. We're beginning to see some layoffs trickle through the economy, things like that. But for the most part, if people are working, it gives them a lot of confidence. And when they have that confidence, they're able to spend money, they're able to be productive. Even though interest rates are high, they're still buying houses, buying appliances, doing those kind of things. So I think this chart is going to be very telling as to where we go from here. And when this begins to soften, we had a jobs report today that was a little bit less than expected. And interestingly, the market goes up. So it seems to be when there's bad news is when the market responds positively. And I think that's for a few reasons. But I can't talk today about the markets if I don't touch on the Magnificent Seven. So if you haven't heard this phrase yet, these are the top 7 stocks in the S&P 500. And it's made up of names like Apple and Meta, all the names that are exposed to artificial intelligence. Is these parts of the market, as you can see on that top chart graph, have done extraordinarily well, anywhere from 60 to 80%, depending on the name. They've gone up this year. Well, the other two lines are the equal weighted market. So all 500 stocks equally weighted. And as you can see, they're down, as well as the bond market. And so the performance this year has been highly centralized in these 7 names. And so what the market is saying is that only 7 companies are making money. And we all know that isn't the case. Earnings growth is strong in lots of different industries, but the market's only recognized these. So that to me is an opportunity. That tells me there's a lot of companies out there. I like to contrast Comcast with Apple. So Apple's a great company and it continues to do well. But on an earnings basis, their earnings per share growth hasn't been as strong as a company like Comcast. But Comcast on a market basis is a third of the price compared to its earnings and continues to go up. Their earnings continue to go up where Apple's have pulled back a little bit. So the market is missing some of this. Now, the market's smarter than I am. It's going to do what it wants to do. It's going to prove the most people wrong that it can. However, this means that there's probably some opportunities in some of these high quality names that haven't gone up as much. And so when we talk about the Magnificent Seven, their actual earnings growth rate, this chart graphs the companies in the S&P that have grown their earnings per share by more than 25%. And as you can see, only one of them is listed in there of the Magnificent Seven. So there are plenty of companies out there that are continuing to grow and to do well that might make for some good investment opportunities as we move into year end here. So the other thing is that the consumer is incredibly gloomy. Even though we all have work and we all have apparently some dollars to spend, consumer confidence is still very low. And I think a lot of this has to do with just geopolitical upset. There's a lot of rough things going on in the world right now with the Ukrainian war and the problems now in Israel. And so I think just a lot of folks are thinking, man, the world is in a bad place. Our politics, as you know, are a mess. And so the consumer is gloomy. And so I say that, though, because whenever the consumer is super confident, the returns in the market are only about 3%. But when they're troughing, when they're lower, that upward trend is actually about 24% in the year ahead. So I also think that as the consumer is beginning to rebound here a little bit, still below average, but if they get stronger into the holiday season and we begin to see recessionary pressures abate a little bit, you could see the consumer do well. This usually portends a good move in the market. So much is driven today by what the Federal Reserve is doing, not only what they're doing with interest rates, but what they're communicating they might do with interest rates. And so they're indicating at this point that what they have done to this point with the 5.25% raises that they've done over the last year and a half, that it seems to be working, and they've definitely slowed down. And so they didn't raise it this most recent meeting. There's still indications that they may have another 0.25 point raise in them, but it's pretty safe to say that they're near the end of their interest rate increases. And so if that's the case, then a lot of folks are beginning to believe that actually the rates could begin to come down. And so the reason they would do that is if they do throw us into a recession, if we do have a rough landing like we did in Rhode Island, and all of a sudden the economy really starts to flag, they could lower rates to stimulate some growth. And so this chart is showing in the green that the market is expecting that. And that's why I think, for instance, today the market is up, because with a softer jobs report, that means that the economy is beginning to reflect less hiring and less growth. And that then could lead to where we're either recessionary or just flat in the economy and give the Fed a chance to lower rates. So this is by no means a guarantee, but it does show what the market's expecting, and we have to kind of behave accordingly. All right, this chart just shows the bond market over the last number of years. And as you can begin to see, last year is when it started to flag. And what happened is bond prices go down when interest rates go up. And so it's just math. And so people don't want a 2% bond when they can get one for 5%. We've been investing in treasury bonds and CDs above 5% now for the first time in a long time. And so while those rate are great to see, if rates begin to come down, we're going to want to see how we manage that. And so I just wanted to show that bonds have historically been an easy, straight up place to go. They're much more challenging now. And so buying individual bonds, I think, is a great solution to this. And this is work that we're doing more and more of in our client portfolios, where we can find an attractive individual bond or treasury bond or even a CD that can give these yields of 5% plus that don't lock us up for a long time, give us the ability, if rates do go up, that we can benefit from that. And as that rate, those yields and rates begin to level off, once again, I think that's going to be some good opportunity to lock in rates for even a longer period of time if they do eventually start to come down. As I've been telling all of you in our meetings, my biggest concern next year is the election. And as we move into the next year with the political noise as we go through caucuses and then all the primaries, it's going to create volatility. It historically always has. And the noise will be who's winning on a given day, who takes this primary, who does it look like it's going to be in the White House, how does that affect the Senate and the Congress? All of these things can create volatility because what it's creating is uncertainty. The market hates uncertainty. And so you can see here from all the different dynamics, there's very little difference between who's in the White House and who's in the Senate. What I would have you, as far as how the market behaves, is my point there, is that in many cases, who's the president doesn't actually matter a lot to returns in the market, even though they love to take credit for it. Not when it's down, of course, but when it's going up, they want absolute and complete credit for that. But if you look at the right-hand side, the split Congress, is when we get the best rates. So when there's gridlock, that means, I guess, that they can't change things or legislate anything to damage the market. And it also creates a little bit more certainty because they know they're not going to get anything done. And so I thought that was kind of interesting. And then over time, as you can see, whether it's red or it's blue, the market continues to go up back to the decades, back into the Depression era. And so again, longer term, the election won't have likely a big impact on the market. Shorter term, it definitely could and probably will. And so we just want to stay diversified. We want to stay focused on the things that we can control. So if there are good bond alternatives, if we want to raise some cash, if we want to diversify outside the United States, these are all tools in our tool chest that we can look to take advantage of as we move forward here in this new dynamic. So, all right. I say all that to say we've had a very good week here in the market. September was rough, October was mixed, and now here in November, since the beginning of the week, we're up over 5% or almost 5%. And so it's interesting. It doesn't take a lot of news to create quick changes in the market. So we want to stay invested. We want to keep playing offense where we can and understand that when there's a lot of unknowns like there are now, we do also have to play some defense and cover both sides of the field. And so as we move into year end, we'll be looking through all of your accounts for tax loss provisions, things that we can do to offset capital gains if needed, making sure that everything's in order for required distributions, basically going through our entire year-end checklist for all of you. So if you have any questions about that, if you want to have a call with us, please reach out and do that. If you have any questions as a result of today, you can email Will, or you can also always get a hold of me, and I'm happy to talk about what's going on out there, and we'll go from there. So thank you all for being part of this today. It will be recorded, and so we'll be sending out the recording to everybody as well. If you've joined us here live, I appreciate it. And any feedback from how this worked, I would love to hear from you. So have a great weekend. Thanks.